Hello, everybody, and thank you for joining me today. It's Allan Barry Laboucan with the Rocks and Stocks News Show. We're at the end. Well, we've had the end of the second quarter, and at this time, I've sort of started a new tradition. At the end of each quarter, I look back on how I started the year with my Outlook 2025 report in this case. And there's some really good stuff that I think will bode well for many of the assets that I'm favor and throughout the rest of this year. So I thought I'd look at a combination of where we are in relation to the Outlook 2025 report and how that's going to play out for the rest of the year. So as you can see, I put out my Outlook 2025 report on January the 2nd. I started it out with gold. In the gold part, I said that gold's in the earliest days of a renaissance as investors in the East and central bankers in the BRICS and others are loading up on gold. I think they've come to terms with the fact that the debt and fiat currency system is broken. Those in the West have yet to come to that reality that there is a death spiral of debt and relentless devastation of purchasing power of their fiat currencies. This is consistent with every fiat currency, to tell you the truth, and the debt situation. It's the debt and fiat currency system is broken worldwide, and that's why gold is trading at record highs against every fiat currency. I then went on, which is causing massive problems that will require a rebuilding of the entire economic system, with an emphasis on gold being the foundation. I, that has not changed one iota for me. I still believe that with the broken fiat currency and debt system, that gold will have to play an important role. Uh, I said that these issues started when Nixon took America off the gold standard, which allowed politicians to create debt with no meaningful restrictions, and they cranked up their fiat currency printing press to devastate the purchasing power of the US dollar. Pretty much everybody in the G7 did the same. It is still the world reserve currency, but gold looks to take a run at it as it has surpassed the euro to become the second leading reserve currency. A lot of people are paying attention to the gold jumping above the euro. I've seen some of the big publications and major brokerage houses talking about it. What is not as well known is that, a few years ago, US dollar made up about 60% of the world's reserve currency held by central bankers. And now it is below 50%. And gold is making a move against that leading reserve currency. I think in the next couple of years, 2 to 5 years, be the number one world reserve currency. Uh, Investors in the East and central bankers, this is going on with that report right here. Investors in the East and central bankers in and outside the BRICS alliance are on the path to putting themselves on a modern version of the gold standard. I think that's consistent with my earlier comment about the inroads that gold is making against surpassing the euro and now making inroads against the US dollar. They were forced into it after the 2008 great financial crisis, as they realized they held too much US debt and US dollars. This started them on the path of divesting their holdings of the US debt and US dollars. Then in 2022, 2023, 2024, and now into 2025, they amped up their purchases and went on a gold buying spree. Gold's performance has been driven by a combination of the death spiral of debt and the central bankers in the BRICS alliance, buying. With Trump winning the election, having proved he loves to create debt, the reasons to be bullish on gold are in place for 2025 to rival 2024 by setting a new series of record highs. My speculation is that gold will reach 3,500 to 4,000 range this year. 3,500, I think, is a piece of cake, and I think we'll get to 4,000. And I'm going to go into the chart and show you why. Uh, so this is a daily chart. And before I get into the daily chart, no, we'll stay at the daily chart. Okay, so as you can see, 2024, early February, January, February, kind of had a double bottom there and broke out quite significantly. I predicted this. Anybody wants to see my predictions, just go to my Substack and look back to the reports I was writing in the early part of 2024. But I want to point out some things here. You see this period here from early 2024 to it actually had started back in 2023, but there was a basing period and then a significant breakout. I actually predicted this would happen. And again, check my Substack. But as you can see, after the base, it had a nice run. Went from about the, let's say, 2000 to 2400. Then it went sideways for, after that peak in April, let's say the third week in April until about the early July. It went sideways. Well, you could even include that right till, let's say, the July lows there. Then it broke out again, this time from around the $2,400 level to pretty much 2,800. Okay. Then it had another basing period right here from November till early 2025. Let's say the base was at about 2650, and then it had a beautiful breakout all the way to over $3,500 or yeah, 30 reached 3,500 almost pretty much on that spike there. So that was another phenomenal run. And now I think we're in another basing period. So now it's been since, let's say, late April till now. It's been creating another base. And I think we're going to see another rally, this time taking it over 3,500. Now, another thing that I find really interesting is you look at this base, then this base, then this base, and now this base. Each progressive base is significantly higher than the previous base. And I would even say that on the rallies off those bases, they're longer and stronger than, well, this one was pretty strong, but not as long as this one or this one. So if we see something like this, so it went from about 2,600 to, let's say, 34 and change really was the top, not take out that spike. 26, that's $800. So if we get a $800 move from this current base at about, let's say, average during the base is around 33.20, that takes us over 4,000. And this could definitely, we've got plenty of time to see this kind of a rally before the end of the year. So that's my stance on gold. So then I talked about silver in the 2025 outlook. And on the silver commentary, I said, silver has remarkably bullish fundamentals. It's a monetary metal like gold, but has not really entered into the gold bull market yet. I would say it has of late. Gold made several new record highs in 2024. Silver is still a long way from its record highs. That is still true, but it has made an important rally recently that I'll talk about in a few minutes. I go on. This in itself is a powerful argument that gold is still in the earliest days of a bull market. Whenever gold is in a bull market, the other silver participates, the other metals participate. We're starting to see that of late. In every past gold bull market, silver joins the party and starts significantly outperforming gold on percentage terms. That still has not happened, although it's made a big rally, important breakout recently. Then I went on. It is somewhat surprising that silver has not yet joined the gold bull market party, as it has been in a supply deficit for the past few years. That goes on. That continues. A very big one, as physical demand has been around 200 million ounces more than physical supply. So we've had 4 years now of that kind of deficit between physical supply and physical demand. Key drivers of the deficit are that mine supply has been unable to increase, while demand has been very powerful from solar panels that are getting cheaper and a very good alternative energy source in several jurisdictions. I live down here in Mexico, and it's a wonderful option to get very cheap energy that's reliable. One of the reasons people feel that silver hasn't been stronger is because investors are looking at it more as an industrial metal than a monetary metal. I think that's changing as of late. The deficit has been filled somehow, but it is unlikely that it can last much longer. The deficit in silver production from mining is around 800 million ounces annually, and with around a 200 million deficit for the past few years, silver is ready for a massive move, and we've recently had an important breakout. Go on. The bullion banks are the likely source of the supply that has filled the deficit, but they must be running that down to critically low levels. They are putting themselves in a precarious position with so much paper derivatives trading with diminishing amounts of physical silver to back that up. At any point now, I could see us wake up to the beginning of a tremendous bull market for silver, and as it has one of the best setups I have ever seen in any metal. I still believe that to be true, but we are having a nice breakout of late. My speculation on the price of silver in 2025 is that we will see it get well above $40 per ounce, with a chance it could take a run at its record price. I'm starting to feel that $40 is no problem this year, and maybe even we get to that record price. Now let's get to the silver chart. So, silver is also over the last year gone from the lower left of the chart, like gold, starting at about $2,200 in early 2024. It maybe not, kind of had a sideways action here for, let's say, May until recently, June, early June. But I really am impressed by this big breakout here to 37.14 on the close of the week. And I'm going to go back to a longer term chart and tell you why I think this breakout is so important. So this is the weekly chart that gets us back to 2018. And you notice that in this from 2018 to 2025, so about a 7-year period, look at how little time it has spent above even $30 an ounce, pretty much since 2024. Okay, so it's pretty much really took until then to break out. But let's go back in a monthly chart. And so here you can see the end of the 2001 to 2011 gold bull market. Um, the last spike you would see like this, you'd have to go back to late 1970s, early 1980s. But I want to point something out here that, again, since the 2001 to 2011 gold bull market, look at how little time gold has spent above $30 an ounce. This was a spike that didn't last, and then it just got pummeled and kept on getting pummeled till it got down to about $15. So that in a nutshell, and you can go back, you have to go back all the way to the 1980s, late 70s and 80s to see the last time it had its big run to $50. So you look at this run since 2022, or even go back to, let's say, 20 early 2020. This recent action from 2024 and recently, I think, is much healthier and more long lasting than this move that we've seen. So, you know, whether I look at it at a monthly chart, a weekly chart, a daily chart, all of these point to this being a very important rally, really significant breakout. And that's the thesis of why, well, the fundamentals are strong demand and weak supply, but the technical chart tells me that this gets us to $40 probably before the end of the summer. Could be before the end of July, to tell you the truth, because this is a very impressive breakout. All righty. Now I'm going to go back to the 2025 Outlook report, if I can get this screen to cooperate with me. All right. Then I talked about copper. These are my key metals that I follow: gold, silver, copper. So I said in the 2025 report that copper is the most critical metal in our electrified world. We constantly hear about alternative energy, the need to rebuild aging power grids in developed economies and build new ones in developing economies, electric vehicles, artificial intelligence, and many other things that need massive amounts of copper. What we hear less about is where all that copper is going to come from to make all of these things work. Now, recently, we're getting a signal of how tight the supply is. The smelters are having a very difficult time to get copper supply for them to smelt. And they're actually paying producers to bring them copper. That's a very unusual situation, and I think it's very indicative of the tightness of the supply of copper. So then I go on. For the past couple of decades, new discoveries of important copper mines have fallen off a cliff. Most of the copper mines being depended on now were discovered in the 1980s and 1990s. It takes 15 to 20 years to find a copper mine and bring it into production. The supply chain is broken precisely when it needs to be perfect in order to meet the near term and long term demand. It isn't, and it won't be able to, which will drive the price of copper multiples from its current price. Again, we're getting evidence of this with the situation with the copper smelters not able to get what they need to keep their facilities making copper. I then went on: higher prices will help spur more exploration and new mine development, but it won't fix the problem. If you look at the supply chain, it, you know, we're not finding and developing nearly to the rate that we need to meet the future demand. And that was before artificial intelligence, electric vehicles, robots. These are big energy and copper users that we need a lot more copper. Uh, I then went on, it still takes massive amounts of drilling, years of economic studies and permitting, then billions to develop them and bring them into production. People may want to turn on the switch for all electrical products, but turning on a copper mine is much more difficult. Every major mining company has a hunger for more copper mines in their portfolios. But due to the decline in copper discoveries over the past couple decades, the copper cupboard is bare. The broken copper supply chain is very bullish for the price of copper. My speculation for 2025 is that copper gets into record highs above $5 a pound and stays there for the foreseeable future. All right, so let's have a look at Dr. Copper's chart. Okay, so here we are looking at the daily. And again, another metal that started 2024 at the lower left of the chart, and it's up towards the higher right. That's a very bullish indicator on its own. Copper had a very good run from February lows until the May highs, where it made one run at $5 plus $5, five and plus five. And then in 2025, not long after I made my 2025 prediction, it took that run I was talking about to five, and it stayed there. And then the tariff tantrum happened, and that took some wind out of its sails. But it's been in, getting higher highs and higher lows of late, and recently has also made a very significant breakout. You look at those June lows of, let's say, 474, it got up to 520 and is today closed on Friday at 506. So this is the move I talked about at the beginning of the year was going to happen. And that what I'm really looking for is it to go over five and stay above there and then make a run at new record highs. And that's where I think we are today. I think we're at the point of now above $5 a pound and to make new record highs. But so here's a double top, and I think this will be the big breakout that we've been looking for. But let's go back to the weekly chart. So it's again, it took one run at it here, reached it at five in early 2022, 2024, early 2025. And if you could make the case that this was a big basing period, let's say at about $4.30, 440. And now we're at the verge of a big breakout here, which I think that's the case. I'm going to go back on the monthly chart, and oh my gosh, reminds me of the hard days in the copper projects back in the early 2000s when it was trading at about 60 cents a pound. Had a great run during the 2001 to 2011 bull market. Had a cup and a handle, and now I think we're having the breakout from that handle. So yeah, I think I got the calls right on my key metals pretty darn good. Alrighty, so then I talked about gold, silver, and copper stocks because ultimately I think that that's the best way to play them, the bull markets for gold, silver, and copper, because the stocks are so beaten down. Okay, so I said gold is on its way to resuming its important role as a key reserve currency and the key to fixing the unsustainable growth in debt and devastation of purchasing power of fiat currencies. The economic world is on a path to a modern gold standard. Countries and investors that understand what is happening and are prepared will be well positioned to protect their wealth and their purchasing power. We're still in the early days of backing up the failing debt and fiat currency system. And as more countries build up their reserves of gold, then we will see a transition to gold resuming its past glory as a key currency for international trade. It is the soundest money by far. The powerful bullish trend in gold during 2024 has been very good for best in breed gold miners like our top gold miner picks, Agnico Eagle and Alamos Gold. They have significantly outperformed gold and most of their peers. So far, only the big gold miners have joined the bull market. That was what I was saying at the beginning of 2025. And tomorrow I'm going to do a report and I'll talk more about the gold and mining stocks then, but and make my case of what's happening now. Um, then I went on. The same thing happened in the 2001 to 2011 gold bull market. First, the major gold miners moved, then the mid tiers joined in, followed by the new mine developers, and finally explorers with important discoveries. The gold bull market hasn't really moved down the food chain yet, but 2025 is primed to be the year that it does. Actually, that's happening now as well. I also expect to see silver and copper stocks join the gold bull market as well. When I talk about my stock picks tomorrow, I've got some silver and copper stocks in there, and you'll see that that's what's happening as of now. When it comes to new mine developers and explorers with important discoveries, there is a very tiny menu for investors bullish on silver and copper to choose from. They are rockets ready to blast off. And some of my picks have done that. Over the past several months, I've been doing a lot of deep dives into projects of companies that I follow closely. The goal of this work is to prepare myself to do a series of deep dive video reports starting in the next few days, and that's ongoing. I've been going over drill holes, maps, scientific papers, technical reports, and discussing projects with geologists and company executives. I used to do a lot of consulting prior for a large geological consulting firm uh, before I got into writing my newsletter in 2005. And I'm kind of reviving that consultation stuff, work that I've done in the past. My mentors in geology, geochemistry, and geophysics have helped me over the years to be able to take highly technical information and present it in a way that investors that aren't geologists can appreciate. That's the nexus, if you will, of what I do in my reports. And also when I talk to public companies, what I try to get out of them. The couple of themes that I'll be discussing in this series are where a company is in the Lassonde curve. My readers know I talk about that as well a lot, as well as where they are in a gold, silver, and copper system. This is really important when you're looking at explorers and developers because they can have a lot of blue sky or they can have um, hurdles and difficulties. Where they are in the system is crucial. Understanding these topics are a great way for investors to better understand the value proposition in a particular company. As I've been doing my prep work, I have been overwhelmed at how much unlocked value I'm finding in several gold, silver, and copper projects. That has changed of late. And I think that this is why I've recently been writing about us being at the early days of another metals bull market that will rival the 2001 to 2011 metals bull market. Now, if you want to see those reports, just go to my Substack, rocksandstocks.substack.com, and you can see all my reports going back from the start of when I started. I transitioned from the Allan Barry reports to the Rocks and Stocks News about 4 years ago. So everything that I've ever done with Rocks and Stocks News is on that Substack. Now, I also highlighted something that I think is important for investors in the sector, as well as for the company executives that run these companies. In the past, I used to really almost, let's say, 70% of what I cared about was the project and the results and what was coming out of those results. And because of, you kind of got to go where the puck is going, as they say. And investors are on digital marketing platforms like Twitter, YouTube, and others. And so it's like it's a big investor conference every day, all day, 365 days a year. So this is good because it gives companies the opportunity to speak to those investors. But it is also challenging because those investors have a lot to look at and keep their attention. So to really effectively do digital marketing, you have to be consistent. You got to be out there. You got to be creating content. And this is what I talked about in this digital marketing for miners in my 2025 outlook, because I think it is so crucially important that, you know, to get noticed and to stay at the top of the mind of investors, you got to be talking to them in videos, interviews, on social media, especially on places like Twitter. The community there of investors is just insane. Same thing could be said for YouTube. And that's what I focus on. So I went on in this 2025 outlook, and I said, in addition to being convinced that there has never been a better time to be bullish on gold, silver, and copper, there has also never been a better time for miners to promote their projects with some of the great digital marketing tools at their disposal. The mining industry has a terrific story to tell and broadcast across the digital airwaves. Without mining, nothing in our modern world gets made or operates. Although the mining sector is crucial for everything, it doesn't get much help from the financial media and brokerage industry. They, especially in the United States, bit better in Canada. Europe is much like the United States. The brokers are busy with other things. Financial media doesn't care about mining. I think that's crazy because in order for everything in our modern world, we need mining. You want robots? You need mining. You need copper. You need other metals. You want artificial intelligence? You need those same metals. You need energy. So everything happens because of mining. Um, but as I go on, which puts the industry in the position that it has to take the storytelling bull by the horns and tell the story of how important mining is to the modern world. Fortunately, the tools to do that are available like never before. Investors are on X, formerly Twitter, and YouTube, consuming content and networking to learn about metals and mining stocks and then promote them to each other. So that's another reason you got to get out there. Another one that I don't think, sadly, that mining executives really pay attention to is it's almost like a question and answer opportunity wherein investors are telling them what they see or don't see in their companies. That's phenomenal feedback that can only help mining companies that use that information effectively. So again, it's mind-boggling that more mining company executives are not out there doing that. They talk about marketing all the time, and I wonder what marketing are they actually doing? Are they going to where investors are these days? Because investors are on Twitter, X, they're on YouTube, they're in other places digitally. If you're not out there doing that, you're behind the eight ball. I am seeing more and more mining companies that are embracing the digital marketing tools to help spread the word about the metals they are involved in and what their companies are doing to unlock shareholder value. This is a welcome trend, and I think it will only pick up momentum. And if it doesn't, these companies get left behind and their cost of capital goes up. Another reason that I am so bullish on mining companies more aggressively using digital marketing tools are the analytics that the best websites provide. In advertising, a well-known saying is, half the money I spend on advertising is wasted. The trouble is, I don't know which half. That is certainly true for print ads and television ads, but not true when it comes to digital marketing tools, as they have back-end analytics to track all the key engagement statistics. For example, on YouTube, people look at the count or the video views. They don't really pay attention to the reality that you can buy video views. And so, that's not really a great indicator, but you go on the back end of your YouTube videos and you can see the engagement statistics. So you can see how long investor watches the video on average throughout the entire amount of people that are watching them. You can see, these engagement statistics are what's important because that tells you if the interviewer and the interviewee are speaking in a way that keeps the attention of the audience during that video. So the first analytic is not the most important. It's the engagement statistics behind that. I go on. It is also true for traditional marketing method that mining companies have used for, oh, this is where I was talking about wasting money uh, on marketing the traditional way. I said it is also true for traditional marketing methods that mining companies have used for many years, which are mining conferences. A couple of days ago, I heard a great comment from a young mining executive. He said that he is only going to mining conferences, also provide video coverage of his presentations. He spends most of his marketing time on online, YouTube videos, interviews, that sort of stuff, and said basically, if I do go to a traditional mining conference in the future, I will only go to those that have video content because then he can see it out in the public domain and it keeps on keeping on, if you will. His reasoning was that he has plenty of great one-to-one meetings with investors when he goes to the mining conferences, but is unsure of how much value that has for the money he spends. He added that if there are videos of his presentations, they can be consumed by many investors. It was music to me, my ears, because I have been trying to get that exact message across to mining company executives for many years, and I am still trying. His company has a great project, and he does plenty of online interviews and can see the benefits from that in his stock valuation and trading volume. I hope more mining company executives come to that same conclusion. It's kind of surprising because, when I see a video, I often will then go look at the stock chart and see if there was sometimes you can see videos that have been watched 50,000 times, 100,000 times. and the stock trading volume doesn't budge. That tells me that most of that audience, it's bots, that video views that have been purchased by bot farms that click on the video, then click off of it within seconds. The mining sector is crucially important as it provides the raw materials needed to make everything in our modern world. Plus, there are very compelling bullish arguments for metals and for the companies exploring for new discoveries, developing new mines, and mining metals. Miners have a tremendous story to tell, and it makes me happy to see the industry more effectively using digital marketing tools to tell their stories. I think they're still way behind the curve, but it's improving. It will ultimately help the industry draw the attention it deserves for mining metals and the companies. Okay. Then I went on to politics, interest rates, stock market, Bitcoin, BRICS, and the US dollar. I mentioned that in the 2024 year in review, I wrote about why I think the above topics are bullish for gold, and there's a link there for you to find that. Politics. Where debt goes, so will go gold. Trump made a lot of campaign promises to get elected, but keeping them will be an entirely different matter. His key advocate, Elon Musk, has talked a lot about out of control spending that could bankrupt the country. He is right, but getting politicians, including Trump, to slash spending is an insurmountable hurdle. Politicians on the left and right love spending and growing the debt, which is why the debt to GDP ratio is so alarming. Kind of coincidental that, as of yesterday, Trump and GOP-led House and Senate have pushed through their big spending bill and will only continue to increase the deficits, increase the debt, and increase the cost of servicing the debt and drive the debt to the death spiral of debt further forward, and that's very bullish for gold. I went on. America is the biggest economy in the world, but it also has a debt to GDP ratio climbing at an alarming rate and at a level that in the past was reserved for only basket case economies. Much of the spending is ingrained in the system: Medicare, Medicaid, Social Security, interest on the debt, and defense consume more than what comes in from taxes. And that's going to continue with this big spending bill. They are untouchable. Everything else the government spends money on pushes the deficit to over 2 trillion. This new big spending bill, it's going to, within a year, I predict, we'll see 3 trillion deficits. Those expenditures are how politicians pay off their financial supporters and how they get rich in office from kickbacks. They never change. Politicians on the left and the right will fight tooth and nail against cutting any of that spending and will have nothing to do with slashing them. Oh, yeah, the big spending bill talks about future cuts, but those cuts don't come in until after Trump is gone and a new group comes in. We saw that in the recent funding battle to keep the government running, that then cut down the pages in the initial huge bill that had bipartisan support while keeping all the spending. And that is the same thing we're seeing with this big spending bill. Even more telling about the spending that will happen during the next administration is that this was prior to Trump taking office, by the way, is that Trump wanted to eliminate the debt ceiling. They ended up raising it by 5 trillion in this big spending bill. He was and is a debt junkie, and that certainly hasn't changed. Proof is in the pudding. You can talk about all you want about the on the campaign trail, but the big spending bill tells you he hasn't kicked his spending and debt addiction, and he's still the same junkie he always was. He will cut taxes without a plan to pay for them, only hoping that they will trickle down to the economic growth. It didn't work for Trump in his first term, other than to widen the gap between the rich and everybody else, and it won't work in his second term, other than to drive the debt higher. Case in point, the big spending bill. I, I think these comments will only prove more prescient as we go forward. He also wants mass deportations while the economy needs the cheap labor from immigrants to keep it together. If he goes ahead with his plan, which his MAGA crowd is demanding, he will slow the economy when it least needs it and also drive up inflation. That is happening. The only reason it's not moving towards a recession yet is because the way he's implemented those tariffs caused front running for companies to import as much as they could to not have to face the tariffs, which gets you some better, it's like a sugar high for economic numbers. But coming into the summertime and into the fall, I think we're headed towards a significant economic slowdown, possibly even dip into recession, but then see 3 to 4% inflation in the government numbers, real world, probably more than 5%. And that's stagflation, folks. I talk about that in a lot of my recent reports. And then I went on. Elon Musk and his fellow tech bros also need cheap labor from H-1B visas to keep their costs down and profits up. Musk's support of importing tech workers while deporting others is a topic that is boiling over and will cause a huge chasm between his fellow tech bros and the MAGA crowd. That was pretty prescient because Trump and Elon are having a nasty divorce over the last month or so. Trump talked tough about tariffs before and after the election, but if he goes ahead with them, which is another campaign promise he promised the MAGA crowd love, he will cause more inflation. He may be able to fool voters into believing that foreign companies pay the tariffs. They don't, folks. The importer pays the tariff and then passes it on to when the product arrives in the United States, and then passes it on to consumer. Recent reports are 3 out of 4 companies that are passing those tariffs on to, and it hasn't really even gotten underway in the real economy. I go on, but the reality is that they pass those on to the consumers that want to pay to buy their products. In addition to causing inflation, it will also slow down the economy when it is already on shaky ground. The bottom line is that Trump will spend like never before and likely run the debt up to 50 trillion by the time his second term ends. I think I'll be proven right on that. Plus cause another wave or two of inflation. I think that's coming this year. He said that America is headed toward a golden era. Well, he did get that right, in that he will be proven right as his policies drive gold much higher. Interest rates. Just let me scroll back here for a second. Okay, interest rates. Let's get here. Bond vigilantes are worried about a second wave of inflation as they are on a buyer's strike and are driving yields up. Meanwhile, Powell is saying the economy is great, the jobs market is great, and their interest rate policy is great. Voters don't agree with Powell as they showed up on election day to voice their displeasure with jobs, the economy, and inflation. Voters and bond vigilantes have it right. They have plenty of reasons to be concerned. Even the Fed policymakers are predicting the economic growth will significantly be significantly lower than inflation. Months ago, Powell said he doesn't see stag or inflation, But if you pay attention to their forecasts inside the Fed for economic growth and inflation, they are making the case for stagflation. And in subsequent meetings since this Outlook 2020, they have continued on that trend. They're now worried about a recession and 3+% inflation. That's over 3% stagflation. That is very bullish for gold and silver. I've been talking a lot about that in recent reports. The last time there was stagflation in America, it was in the there was stagflation in America in the 1970s. It was very bullish for gold, and it will be again, silver as well. The real economy is much softer than the government statistics suggest, and combined with Trump policies, it is likely to slow down to well below the target rate of inflation, which means that the Fed will have to accept higher inflation and lower rates to spur economic growth. Now, Trump is demanding and insulting and throwing everything he can at Powell to get him to cut interest rates. Powell has so far not cooperated, but ultimately, I think, well, he can do that for the next year until he's out of office. Then Trump will put in somebody who will help him get back towards the free money era. This won't be easy because the bond vigilantes aren't cooperating. I see a few factors coming into play on interest rates in 2025. The jobs market and economy are going to need lower rates to keep them from declining into serious recession or troublesome stagflation. That is on its way. It's been here for pretty much all of 2024 and is only going to get worse. In order for the Fed to keep cutting rates, they will need to, at that time, they were cutting rates. They will need to get back into the QE business for two reasons. One is to manipulate the yields down. And secondly, as the bond vigilantes stay on a buyer strike, the buyer of last resort will need to get in and buy. I suspect we will be hearing more about stagflation and quantitative easing in 2025, likely in the first quarter of the year. This will put wind behind the sails of the gold bull market. We are certainly hearing more about stagflation. When I started writing about it in 2024, practically nobody was talking about it. Now, many people are talking about it. Even the QE is starting to get talked about. It's not mainstream talk yet, but people are seeing the writing on the wall. Now let's let's go look at bonds and see how let's go to the 10-year. That's kind of the middle of the road one. So, and bear in mind that as bond prices are in decline, yields are up. So as we saw here at the in September, while Powell had cut rates, the bond prices went down and yields went up. So the bond vigilantes were not cooperating with Mr. Powell and the Fed. Then they bottomed in early 2025 and started going up, peaked, and have been sort of going sideways. I think that with the amount of supply that there is of bonds out there, that there very well could be a correction, a serious correction that drives yields up at a time when Trump and his Trumpanistas want it down. You got a huge amount of supply there. Who's going to buy it? The foreigners. Trump is making all the foreigners mad with his tariffs. They own about a third of the debt. The Fed owns about a third. So, you start to see where's the buying going to come from? The buyer of last resort, because if the foreigners are losing money, you'll see how they're losing money on the US dollar that they get paid their yield in. Why are they going to buy when there's so much supply out there? I think that this correction is portending future corrections and that bond prices are going to go down and yields are going to go up. It just comes down to a supply and demand equation. There is excessive supply, not just in the United States. Japan is feeling that. Other countries in the G7 are feeling so much supply in the United States and elsewhere that the bond vigilantes, why buy with so much supply? It's risky. The prices go down. That's, I don't know. I think they're heading a lot lower. All right. So let's get back into then I looked at the stock market. The stock market, as gauged by the S&P 500, which is a pretty good metric. The S&P 500 is priced for perfection, and the risks of a correction are prolonged market with a bearish bias are high. Executives running the Wall Street stocks see the writing on the wall, which is why they have been selling aggressively into the strength. Warren Buffett has also been selling to build up the highest cash position he's ever had in Berkshire Hathaway. In a market that is trading at a huge premium, he is unable to find value opportunities. He can't even bring himself to buy his own Berkshire Hathaway stock because he sees that it's trading at a premium as well. While Wall Street executives and Warren Buffett are sellers, the rest of the market participants keep driving valuations higher to the point that valuations at the present are present prior to significant corrections. The only reason that I'm not arguing for a steep correction is because I doubt the Fed will allow Wall Street or will throw Wall Street under the bus. Nonetheless, the risks of the downside are much higher than the prospects for significant upside. At worst, there will be a serious correction in the stock market in 2025. At best, it will be choppy and a sideways market with a bearish bias. I think the latter is more likely than the former. So let's take a look at how the S&P 500 is done in 2025. Oh, look, got a pretty serious correction there, and then a V bottom and rally. It was overpriced and priced for perfection here, and it's very overpriced and priced for perfection here. So we got a pretty serious correction, 6,200 on the S&P 500 down to 4,800. So that's like about a 25% correction. Ouch. It did rally back, but sadly, a lot of people sell down here, as you can see in the volume. They sell down here and they don't get back in for the rally, as you can see in the volume. So, it shakes out a lot of people and they don't get to participate in the V rally. But the V rally is only getting them back to price for perfection. And I caution people that are buying these stocks blindly that, it's priced for perfection. Executives and the CEOs over the last couple quarter are no longer giving forward guidance on their earnings or their business due to economic uncertainty. That is the uncertainty of Trump's policies on tariffs, on mass deportations. They're scared. They don't know what to do. Consumers are feeling the same way. And the executives and the CEOs and insiders of public companies are selling into this strength. They're not buying into this strength, folks. I see this Wall Street stock market as toppy and ready for a significant correction. At best, it goes sideways from, let's say 5,000 on the low to 6,100 on the high. and just chops around there. But I also think there's potential for a serious correction. All right. I went into Bitcoin. Because Bitcoin I see today as being like the dot-com stocks at the end of the dot-com bull and just prior to the dot bomb era. Bitcoin is a Ponzi scheme wrapped up in a mania. It is reminiscent of the dot-com bubble before it burst. We will know the Bitcoin mania is over when it trades below the average cost of mining, which is around 75,000 to 80,000 per Bitcoin mine. And when it trades below the average price that buyers paid since the Bitcoin ETFs came out, which is around 65,000. The biggest bull on Bitcoin is Michael Saylor at Strategy, previously MicroStrategy. His average price is above 65,000. While all the Bitcoin bulls believe it can only go up to millions per Bitcoin, and Michael Saylor, its biggest pumper, says sell everything you have and borrow whatever you can to buy more Bitcoin. I see that there is a potential for it to implode. What the Bitcoin bulls don't seem to understand is that it doesn't come from the Bitcoin factory in their fantasy land. The backbone of the system are the Bitcoin miners that mine to make new Bitcoins and also process the trading transactions. There's really no real transactions other than for the trades. But if you wanted to see that happen, you need the Bitcoin miners. If the price of Bitcoin goes below the average cost of mining, then the high cost miners are in trouble and have to shut down. If it goes well below the average cost of mining, then the entire system starts to break down and the price can crash. Bitcoin recently topped at over 100,000, and it looks like the bubble could be ready to burst. Bitcoin and other cryptocurrencies have pulled investors' attention away from gold, silver, and the stocks in those metals. And 2025, I expect to see those trends reverse. All right, let's take a look at Bitcoin. Bitcoin here. Okay, so it had topped around that 110 range. Back here, when I wrote about that report, it had topped at over 100,000. It got up to that 100,000 again. Then it broke down, hit the April lows of 70, 75, but it rallied off of that. And recently it's going sideways. So is this a base before a rally or a base before a drop? There's no value in Bitcoin other than to trade it and hope that, the greater fool theory is tested to the max. But with everything happening, the politicians talking about cryptocurrencies, Michael Saylor leveraging up and as much as he can to push it forward, it's hitting a brick wall there. And I think a correction is much more likely than it to go significantly higher. All righty. Now that I got all the uh, Bitcoin folks mad at me, let's go to the BRICS. BRICS central bankers in the BRICS nations want to own less US debt and US dollars while also want to own more gold. They are concerned about the weaponization of the US dollar and want an alternative to it that gold is perfectly suited to be, not only as a reserve currency that is the soundest money, as it has nobody printing debt and fiat currency around it. Plus, it used to play an important role in international trade, which is happening. It's starting to play that role. And once they get their gold reserves high enough, it will again. This is starting to transpire, folks. Their actions to load up on gold is a clear sign that they aren't fond of the entire debt and fiat currency system. Nobody can blame them because debt is in massive supply and fiat currencies are constantly destroying purchasing power. That's true for the world's reserve currency, US dollar, the US politicians, the G7 countries. They're all drowning in debt and printing fiat currency like it's going out of style. Gold is the true uh, money, real money. Gold is at record highs against every fiat currency precisely because it is the soundest money and has been doing its job to fight inflation and protect wealth. Investors in the East and central bankers in and outside the BRICS nations see the writing on the wall, and it is when, not if scenario, when investors in the West see it as well. We're starting to see that, folks. Gold stocks are start up and down the food chain are starting to participate in the gold bull market. Silver is starting to participate in the gold bull market. Copper, platinum, palladium, the stocks in those, we're starting to see the beginning of the next great metals bull market. I write about that recently. Go check it out on my Substack. The BRICS nations have been buying gold aggressively over the past few years, and everything is in place to see them continue that trend in 2025. Now that we're halfway through 2025, this statement is absolutely accurate. Okay, then I talked about the US dollar and then I closed. So I'm just about finished here, folks. All right, US dollar. The USD index Dixie has been on a run since before the election when it was trading in the same direction as yields in the bonds. Then it went into overdrive after Trump got elected on the hopes that his policies will be bullish for the US dollar. This was between election day and January, late January, when he got into office, that comment was about. Now the US dollar index is looking extremely stretched and ready for a significant correction. Wow, was that ever prescient? As I discussed in the section above on the Fed, I think they will need to cut rates to protect the economy, the jobs market, as well as Wall Street, and ultimately get back into the QE business to protect the bond market because the bond vigilantes are on a buyer's strike. None of these issues will be bullish for gold or for the US dollar, and is heading into rough waters in the early part of 2025 and throughout the year, which is another bullish argument for gold. Did I ever get that one right? Let me take a look at the US dollar action. The US dollar, King Dollar. King Dollar's not looking so kingly with Donald Trump in the office. Look at that. Topped at 110 in early 2025. Actually, almost exactly around when Trump, he was within days of taking office. And since then, look out below. It just keeps on going down, down, down. Trump loves the idea of a weaker US dollar. Yes, him and Besant talk about the importance of holding the world's reserve currency. But the reality is, Trump also looks at the deficit as the trade deficit as how do you say it? It's his thorn in his side, if you will. He wants higher exports and lower imports. Kind of crazy when you think that the US is an importer nation. They don't really export nearly as much as they import, which is why there's a deficit. But Trump thinks that if the US dollar is weaker, it will help the exports. And And that's what he's trying to do. So he wants this lower US dollar. Well, he's certainly getting it because it topped at 110 in early 2025 and is down to 96. So the US dollar is losing ground against practically all the other currencies in that US dollar index. It's losing, and it's really losing ground against gold, the real money, gold, silver. It's losing ground against them, but I don't see this trend is going to stop. I think it's got a lot lower to go. Trump wants it. Vicent kind of wants it, but the boss is the boss. He thinks it's going to help imports. Well, actually, what it's going to do is it's going to cause problems for when you're buying things externally and bringing them in. Plus, you got the tariffs. So if you put that whammy, that double whammy on everything, your importing is costing more. You're putting tariffs on those imports. You know, you've got the stock market trading at record highs, although for the foreigners, well, you know, they gotta they're getting this is causing their gains to be less because they gotta convert that into their own local currencies, which are gaining. So they're not really gaining by owning US Wall Street stocks. They're certainly not gaining when it comes to the US debt market because they're getting paid in these US dollars that are losing purchasing power. So this gives me the belief that I'm going to go off the stop share. This gives me the belief that the three pillars of American exceptionalism that the dollar milkshake people and the American exceptionalists talk about, the three pillars are the Wall Street stocks, which I think are overvalued and susceptible to a steep correction. The U.S. debt, which has tremendous supply, and you know, I wouldn't buy it. I think a lot of foreigners aren't going to be buying it. I think the one that's going to have to buy it eventually, maybe even this year, is the buyer of last resort, which is the Fed. So two pillars have issues. The third pillar, the US dollar, as you just saw, it has issues. So what's an investor to do inside the United States and outside the United States? Buy gold, buy silver, buy copper, buy the stocks in those assets. I tend to follow further down the food chain, but I know that my audience is buyers of major mining companies, major gold miners, mid tiers, juniors, developers, and explorers with important discoveries. So those are the ones that I follow closely. And tomorrow I'm going to do a report talking about those. So yeah, I'm very bullish on gold, very bullish on silver, very bullish on copper, and even more bullish on those stocks and those metals. I'm bearish on Wall Street stocks. I'm bearish on the U.S. debt market. I'm bearish on U.S. dollar. And I think my bullish and bearish outlooks are doing pretty good since the beginning of the year, which is documented. You can go find all my commentary. That's what makes me different than a lot of commentators on the market. They don't make it easy for people to find out their picks, their calls. I make it super easy. There's a reason why I make it super easy because I get it right a lot, a lot more than my peers. And if you want to test my that comment, just go look at my reports. They're easy to find. On that note, have a great day, and we will talk to you soon.